All right, so we have a big week this week with Apple earnings, with among other companies, and the FOMC meeting, which may be their last rate hike, and then the jobs numbers, and setting up for the inflation report next week. So a big week coming up here, and the market started off with one of its smallest range, smallest volume, hardly nothing moves days that we've seen in a long time. Now, granted, we could not have ended the week any better last week on Thursday and Friday. So after that kind of weakness going into Wednesday, if you had a script, the kind of move that we would need to see by the end of the week to kind of avoid the bearishness, if you had to write all that down of what exactly you need to see, we pretty much got it all by the close on Friday. So, and it was such a major move, such a big move, that it's not surprising that you take a little bit of a breather today. Now, the question is, how strong was that move underneath the surface? Because that's been the issue. Headline basis looks great. Underneath the surface, not so good. So we'll break that down. There was a big move today in a few different asset classes as the banking issues seem to have settled down now. So we'll talk about that as well, and what's moving in this sector rotation. And then our trade idea is a stock that we should familiar. We already have a trade going on it from another market outlook video, but we're going to look at a different directional move with a different time frame and talk about how they complement each other. And as always, our goal is to get to 10,000 subscribers on YouTube. So most of our viewers on these videos are not subscribers. So if you haven't subscribed to us yet, hit that subscribe button down below and let's get to 10,000. Let's go ahead and get started. Today is May the 1st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching on our blog here, check out some of these other things over here on the right. You can see we have a new calendar for classes in May that you can register for, as well as some of the other things posted here that Brandon does. Come down here, click on this heart. It opens up this tab. Click that like button there. You can't see because I need to log in apparently. And also come over here and click on the thumbs up icon eventually, if my computer will work. Finally, there we go. Click that thumbs up icon and it takes you to this tab, and hit that like button. Again, the more you do that, it helps get our content out to all of our followers on those platforms. And again, our goal is always get above 100, and we kind of drop back down here. So let's see if we can't get that back up there with one or two really easy clicks right now. If you're watching, those who do that, thank you very much. Those who don't, like I said, you can do it right now while you're watching. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So let's get to the market forecast here. And again, you can see that we're still strong. We're still up. We're slightly down today by a full point, whopping point there. And we failed to kind of get above this. I mean, this is the key level, I think. There's multiple levels in this area. We've got a lot of Fibonacci levels that we've been talking about, right? These two in particular, these narrative changing levels. This is the 50% retracement of the entire correction. So we've now corrected more than 50% of the entire correction. Again, it's not the first time. We did over here briefly, and we did over here for a couple of times. So this isn't the first time. And you can see this line right here is a 78% retracement of this intermediate drop, pretty much the last significant intermediate drop we had, a couple of slight ones over here. We've been pretty much in retracement mode for the last 5-6 months. So now we are flirting with getting out of that retracement mode by going up, in this case, above the 78% retracement. And then, of course, you've got the 4,200 level, which is the 23% retracement of the entire post-COVID rally. So, basically it would be ending that retracement, this entire correction we've been on. We would be ending it by getting above 4,200 like we did over here. Actually, it was... We really, and we got over there, and we were close to ending. It was just the fake out, the pre-Jackson Hole fake out that we had, that when the Fed slapped you down and got us back below the 23% line. That's why this is so. I mean, these are very significant narrative changing levels across the board on multiple time frames. So that's why it's so significant. And again, we tried and we didn't quite get the 4,200. We hit a 4180 high and we closed at we hit a 4195 high and we closed at 4180. Here we got to today we got to a 41.86 high, so not quite. And we closed at 41.67. So not quite getting, I think that's our key level to break above from February 2nd. That was the last time we had the FOMC and all of the big mega cap earnings are released at those times. So very significant level. And, and today a little bit of it, I mean, we had two really strong days. As I mentioned in my technical analysis class at marketscholars.com, you could not have scripted a better end to the week than what we had on Thursday and Friday. And so, considering the rally we had in a big, significant rally we had in 2 days, it's not surprising you'll get a little bit of a pause, way below average in the ATR, and you'll see it in the volume later. So that's what brought the momentum line back in the bearish territory. But at least it got high enough up to extreme levels here that it could get the near-term line up there and keep it there. Right? That's a good sign. That's the good sign that we have. I mean, after getting extremely low levels, which typically marks the end of an intermediate run, we've quickly reversed those extremely low levels up to bullish levels that would be kind of a sign of starting an intermediate run that we did not get over here because the momentum line never did get high. It's kind of like the reverse of what we saw here, where it looked like we were going to really take off with a strong move to the upside, extreme levels, and we just turn right back down. So, it'd be almost the exact opposite. This move would be an upward move instead of this upward move coming on after a decline, a continuation of the decline. We'll see if this ends up being also a continuation of the decline. So that's what you see on the S&P 500. If you look at some of the other major indexes, remember the Nasdaq's been the most bullish. It's looking really, really good. Here's it has multiple lines in this area, including the ones we just mentioned. Now the 50% line for the Nasdaq is up here, so we're not above the 50% line yet. The 78% line we are above, but we have been above that 78% line for quite a while of that intermediate line. This 38%, so the 23% line of the post-COVID rally is way up above too, so we're not close to that. Let me zoom out and we can see that line. So there's that line right there. It's actually kind of lining up with the 62% retracement on the Nasdaq. And then again, you can see this is the 23% retracement of the post-2009 low rally that we had started to retrace back here. We never really did on the SPX. We did very, very briefly got below that line here, and we've been above it since November. We have not been above it on the Nasdaq. But you can see how it's also got its significant levels here that it appears to be that we're trying to clear right now. This is a really, really good sign for the Russell 2000 or Nasdaq 100. The Dow Jones also kind of has its levels. The issue with the Dow that you don't have on the other two is that you have the cluster on the Dow. We got the cluster over here at the end of November at similar levels. You did not get the cluster like we did on some indexes on that February 2nd high point. Remember, we did on the Nasdaq, but we did get the cluster there. We'll see what that turns into. We're still pretty early in the intermediate run. It could still kind of signify the beginning of a move. And then finally, your Russell 2000 has been the weakest. The intermediate line just can't get going. It's actually turned back down. You're back to dark pink shading and a yellow line. So you're kind of flirting here. You can't get more than just 1 day of dark green shading and a green line. Market sentiment still declining. Short-term sentiment, the momentum line did not get the momentum line there did not get into the upper reversal zone. Didn't not even close to those extreme highs. And the near-term line you can see is flirting with it, but again, it wouldn't be the most bullish near-term move if you can't get the momentum line to precede it. So that's kind of the situation we're seeing here. From a weekly chart, when you go back to the weekly, you can see we're continuing to get a good bullish candle. In fact, to the point where the Hakunashi differential has moved back above its moving average. That's a good sign. It is obviously, we had a transition candle last week. As of right now, we are avoiding the reversal. In fact, closing above the week before, the close before the transition kind of nullifies the transition candle. So kind of back up on that bullish trend, higher high, higher close, good to go from that perspective. From a 3 green arrow standpoint, you can see we do have 3 green arrows on the NASDAQ 100, or NASDAQ 100 on the MACD. We don't have 3 green arrows anywhere else. We have 1 green arrow on the Russell, barely. But so you're still kind of flirting with 3 red arrows there, and you're almost to the 3 green arrows on the diamonds and the S&P. Their moving averages are not quite to that point. That would be kind of another, kind of a sign too that we're kind of back on the trend. The MACD is flirting with its moving average. Not quite, it's got to get above that line, and then you can see the stochastics is above its moving average, but not back quite into bullish territory. We're above the 8-day, the 8's above the 17, they're both rising above the 30. I mean, we're right there at the value area, so getting above the value area kind of is like that escape velocity we talk about a lot, where you don't have the pull of the, in this case, 4,000, right around 4,000, the pull of the point of control that pulls you down towards it. So we're set up pretty nicely from that perspective. The DMI is at bullish breakout levels. It's above 25, but it's almost above 30. That's kind of bullish breakout levels. Stochastic, or the negative indicator, back down below 20. So I mean, again, you cannot have written a better script to the end of last week, getting back above the moving average on the stochastics, on the range, looking at the RSI and the CCI, back above 0, and not quite above 150, but at least back above 0. We're still above 60 on the RSI, so we're still in bullish territory there. We never did reverse. The whole reverse back up to a bullish pattern. This is the daily Hakunashi candles. So that's a nice, good reversal on the whole, back to a green line on the whole, with the parabolic SARS flip down to the downside. And then on Friday, we actually broke above the upper Bollinger Band. We're still in the upper quartile, but we broke above the upper Bollinger Band. We still can't get above the Keltner channels yet, but again, you can see we are flirting with it at the highs of the day today. So you can see the bulls are there. We just need to kind of bust through, and that will give us the green dots again as we get going back on a bullish trend. So you see how the bullishness is there. Again, the breadth is still an issue. You have negative McClellan oscillator, so the McClellan summation index is flat. The new highs and new lows. Let's go. That's the breadth thrust indicator. Let's update this one. See if it got back above its moving average. Looks like it hasn't been updated yet today, so we give that a minute. This has been updated, and it's still, it's above its moving average. It's still not positive, so we're still not really like taking off with the strong breadth of stocks above the 50-day moving average of the McClellan oscillator taking up above that positive 35 level, and then of course this getting above, at least getting above positive 100 has been the kind of the mark that kind of signals more bullishness than what we've seen. Again, the rally up to February the 2nd to that peak that we're flirting with now had a lot more breadth than it does now. So this is a far weaker move now than what we saw there. When you look at the oscillator here, you can see we were above 1,000 when we got to the peak there. We're not even above 5. We're not even above 300 or 250 now. So far weaker breadth move now than what we saw there. Here's the money flow indicator, and you can see again, there's our peak on the money flow index on February the 2nd. So we're not getting the volume either to match the move that we're seeing. And you can see that we did have a surge in money flow there at the end of April, but we've been flat below 60, flirting kind of in this sucker zone, neutral zone. Now the question is, which way is it going to get back below 50, or is it going to move back up above 60, and we can renew this trend strength. If you look at the range today and the volumes, this is one of the reasons why today was so weak. The range was pretty much below half the, pretty much exactly half the average, the ATR there, and the volume was way below. So 61 million shares trading hands, and the 2.36 range. 2.36 is way off the charts. 60 some odd million is way at the bottom of the charts here. So, and you can see the ATR relative to its price is really, really low, way below the 1% today. So these are low levels. Volatility did ramp up today, but barely. So it's not that bullish. It generally always moves up a little bit on Monday before falling the rest of the week. The issue here on the VIX is that you've had how many weeks in a row now? 1, 2, 3, 4, 5, 6 weeks in a row of the VIX being strongly to the downside. We've seen patterns like that before here, but that's about the extent. 6, 7, 8 weeks. It was about the extent of that decline, considering how extremely low we are on a relative basis here, as well as to its averages, and then the recent weakness that we've had from a correlation standpoint with the VVIX. Remember, the VIX is well below those early year, beginning of the year lows, nowhere near that here on the VVIX. So that diverging, suggesting that a move higher in volatility is forthcoming. There is a little bit of a seasonal component to that. This is a seasonal time of year for the VIX to be at a low here in this area, end of April, going into the beginning of May, and you generally tend to get a little bit of a pop in volatility here going into pretty much the end of June. Some ups and downs, but you see how we come off of the lows up towards multiple peaks here in May and June before you get that July 4th decline into earnings season, and then back to the strongest increase of volatility that we have all the way until we get to the October earnings season, the beginning of the October earnings season. All right, now let's talk about what's driving a lot of this price action here. So let's take a look at today, just today alone. Remember, small range today, right? From a U.S. equity standpoint, you can see IWM, QQQ, SPY all flat as a pancake, along with EFA. EEM a smaller loss. Gold, you can see pressured. Commodities pressured. But look at bonds. That's a tremendous decline. This is one of the biggest one-day moves that we've seen in long-term bonds in quite some time. Here, let me get to the rate of change, and I'm going to change this to a one-day rate of change. Bear with me 1 second while I do that. And then we're going to take a look at TLT here. Let's go to a daily chart. So here's a one-day move on TLT. Let's zoom out so we can get some perspective on how big of a move this is. So you can see we had that big of a move in March of 2022. We were in the midst of a decline, and we continued that decline. So that was kind of when a lot of this weakness really started, and we rallied. The equity market actually rallied into the end of March there. And then you can see pretty much COVID. And outside of that, look at the moves. Here, let's go to this chart. And then let's go TLT here so you can see it on this perspective. And look at that, 3% move there. Again, you have to go back to right there. Actually, June looks like 13th. You had a 3%, a little bit more actually than what we saw just now, decline over there. But let me zoom out to that same 5-year chart and look how small the losses and gains were over here and how big they are now. So this is a really, really volatile time for the bond market, considering a lot of these banking issues. But remember, today it seems like the banking issues have pretty much ended. If you have JP Morgan making money pretty much hand over fist, buying up these assets, then who does it really hurt? These banking failures, whether it's First Republic bondholders or whoever. There hasn't been anybody necessarily yet that has come out of these banking crises hurt. In fact, it's actually been a pretty decent money-making scheme, other than you could argue the FDIC and their payments. So you're losing money there, and that's ultimately the U.S. Taxpayer. But at that detriment to the FDIC. These banks that are buying these companies, distressed companies, are making money, and so there is no incentive. Like there is like the first day, the first time we had that first bank failure, the first bank failure was early in March, and you can actually see it on the VIX. It was right there, right? In March 7th, 8th, 9th is when things really hit the fan, the 9th and the 10th with Signature Bank, Silicon Valley especially initially. That was when things really, really hit the fan right off the bat. Look at the volatility did. And then you can see, you had a little bit of a bump with Signature. And then this is the bump of First Republic. Early this week, you got a bump up on Wednesday up to 19. So we didn't bump up to 25. We got a bump up to 19. And you were already just 3 days later. I mean, going into the weekend, before the FDIC had ever brokered that deal to JP Morgan, the VIX was already at 15, 15 and 3/4. And then today up a little bit. But I mean, that kind of goes to show what the market, how the market feels about this banking crisis right now. In fact, honestly, it seems like it's actually a good thing when banks fail because you saw, look at what JP Morgan did today. JP Morgan. Look at their stock price today. I mean, it's not, again, it doesn't seem, there doesn't appear to be a negative incentive for banks to fail right now. So we're losing that reaction, that higher volatility reaction. And look at bonds, like they were the safety trade pretty much since the beginning of March. They were a safety trade with all this mess, and boom, just like that, you're back below the 50-day moving average. You've rolled back down. You've hit that 200. You hit the point of control as resistance. Is 23% retracement. You're working your way back down already. When you look at the 10-year yield, which we have been flirting with that 3.5% mark, you're back above the 200-day average at 3.57%. So not quite breaking out. They're not quite looking like TLT, but still. And then you look at UUP, and you see that that's a pretty nice little basing move and move higher, breaking above the 30-day moving average, as well as the 17 today barely, and the point of control. You got a little gap to fill between now the 30 and the 50, and then ultimately the 50 and the 200. You still would be in the value area, so you're still influenced by that point of control. But that's an upward bias there to the dollar and to yields. What you're missing is commodities. So commodities dropping 1%. Remember, those are the three-headed monster that really hit the markets hard in 2022. Was rising bond yields, rising dollar, and then rising commodity prices. And since commodities peaked in June with inflation levels there, we haven't had commodity prices rising. We've been below the 200-day moving average, and we've been easily below the 50-week moving average, as we are flirting with filling in this gap. And remember that the hallmarks of something I've always said is you don't see commodities in correction during a bull market. You don't see bank failures during bull markets, generally speaking. And right now we've had 3 of the 4 biggest bank failures ever, and we've had commodities in a correction since the end of last year. But as was the case actually for much of 2018 into COVID and after COVID, the big reason why we are avoiding disaster is QQQs lifting us up off of these lows. Remember, the Russell 2000, which is a little bit more closely correlated with the financial sector, actually is in a bear market. Well, it's not in a bear market, but it is for the 4th time now making a run below the 200-week moving average, and we're still below the 8 and 17 day. They're both below the 30. The 30 has been kind of flip-flopping with the 50, but the 8 and 17 are both below the 30 and the 50, and they're all below the 200-week. So we're still in kind of bearish mode there. We are in the value area, which means the point of control in the value area acts as a center of gravity, which would pull the Russell 2000 down to 154, IWM, down to 154. So, we're still in that mode, and that's why if it wasn't for the Qs keeping us out of bullish territory, you can see, you are kind of flirting with the top end of that 5-year value area. So you don't have the pull of the point of control, which in this case is way down at the COVID low points there. Now it's going to change. In fact, your point of control is going to be closer up here once we get some of this. It's going to be weeks, but once we get this off the chart, which right now is where a lot of the volume has been, including the COVID volume, and that's why your point of control is there. So the NASDAQ and the strong MACD and strong stochastic and the move up to these Fibonacci lines in the top of the value area is what's really kept the markets from really suffering during this bout of financial crisis, to the point where it's not really even a crisis, right? It's not even an issue, and not really anything we need to worry about, as we've seen over the last little bit. Let's take a look at today's moves, just today alone. So we'll go to May 1st. And you can see healthcare, utilities, health and industrials are all your biggest winners, staples there too. So aside from that industrial move, a little bit of a risk off move from a sector standpoint, though not technically that much of a risk on move when you're looking at like your biggest losers were energy, discretionary, and real estate. Real estate's kind of been lumped in lately with the kind of more cyclical stocks. Energy, of course, kind of its own animal, but you can see how some of these stocks have been performing here just today alone. This is how it reflects on their 3-month charts. Energy, of course, way over here. Real estate kind of matching. I mean, the only thing really that's kind of breaking out to new highs, or flirting with it at least, is XLC, which has Google and Facebook in that one, as well as Netflix and Disney, which are far smaller market caps than those two companies, and then XLK, which is Apple, Nvidia, Microsoft, and then of course Tesla and Amazon, which cannot really get going at all relative to that March 2nd high point, or February 2nd high point, excuse me, which is way over here. And look at financials, look at industrial. I mean, these are not, these four in the middle is kind of your other cyclical sector groupings, and they're not bullish at all, right? And it's interesting to see how bullish your safety trades are, including healthcare. That continues to actually be the rotation. When you look at the relative rotation graph, let's come over here. You can see Nvidia kind of losing some of its steam. That continues to be the relative rotation. XLK, XLC, very strong relative strength and continuing to have that. Here's their charts on an individual level. So let's go XLK. There, you can see XLK, the very strong. The momentum is starting to wane a little bit, and you can see the relative strength is still moving up. XLC would look very similar to that. XLC has got that very, very strong. I mean, these are very high levels that we haven't seen since coming off the COVID lows. Very, very high levels of relative strength and the momentum there. But again, as you saw, that they, how much longer they will continue to go up relative to some of these other sectors, not necessarily financials or industrials or materials that are all heading left right now, which means losing relative strength. Whereas right now you have like utilities there with some increasing momentum and relative strength, and then staples. These are all relative to IWM. I should put SPX over here since that's what we're seeing on that other chart. Dollar sign SPX. I keep forgetting to do that. There we go. All right, so there's you can see the momentum hasn't brought the relative strength line up yet, up above 100, and you can see utilities would be the same way. It is above the IWM, but not here. And again, you see that reflected in the ratio of QQQ to IWM being at extreme highs on a daily basis here. Obviously, we had the big momentum, but we actually finished last week with a higher peak than what we had on that big momentum surge. The long-term PPO is very, very strong here. Not as high as we had been at the beginning of 2022 when we peaked when we had that big discrepancy coming out of Thanksgiving going into the year. Obviously, that started the correction. Obviously, COVID had a big peak too, and we've had a couple other peaks similar to this level on a long-term momentum basis. But that ended up being the peaks at the beginning of 16 and middle of 2014. The Qs were unable to continue that outperformance. And I would expect that to be the case again here. I mean, we're so high and we're diverging on the RSI and the CCI. It's going to be really, really hard for the Qs to maintain outperformance. Like I said, the rotations into safety trades right now. It's not even into the small cap area like industrials, financials, and energy, which are more associated. It's actually just moving into safety. And that's an issue or concern, a kind of reflection of maybe how much momentum we'll have to break through, since we've used up a lot of momentum in these risk on sectors just to get to this point. All right, for our trade idea of the day, I wanted to take a look at Royal Caribbean. Finally it wasn't working for me here, so I had to pause, but we'll start up again. And you can see how the market forecast is turning bullish. We have a trade already on this, an iron condor for May expiration. We're looking at a June expiration now. We have been sideways for a while, and we're continuing sideways. We haven't broke out yet of these blue lines, which is where our break-evens are. Where the break-evens are on the iron condor. You can see we're flirting with that top end of the break-even. We're not quite there yet, but it looks like that's good bullish short-term sentiment. The intermediate line is coming off a cluster with a break above the intermediate line. We're well above the 30-day moving average. Obviously, it's green. We're about to have dark green shading once we get above 50. You can also see, too, that we got a 3 green arrow signal here with a spike in volume, which is always bullish, right? So we got 3 green arrows on Friday, breaking above recent highs with strong volume in the past 2 days. Very, very good sign. When you look at the 2 line versions and other moving averages, you can see the MACD is just barely getting above 0 itself. The stochastics is working into the upper half of its chart. We're above the value area. We're above this volume node that we have been forming. We're above the 50-day moving average. So while we still haven't necessarily broken out enough to close the iron condor, I feel like we are getting some good enough signals that I can kind of complement the iron condor with another trade with a different time frame that's got a little directional bias to it. Breaking above 30 on the positive, below 20 there. That's a breakout signal. Looking at the RSI and the CCI, you can see that's a breakout signal. We were above 60 for a good chunk of the day and above 200 there on the CCI. So we're in bullish levels. We were also breaking above both the Keltner and the Bollinger Bands. We finished above the bands, and they're coming off of very, very low levels, but you're not quite above the Keltner channel yet. We were for a good chunk of the day today before pulling back at the end. So you see, the good bullishness that we have here. Again, not so much enough that we can necessarily close out the trade, but enough that we can say, okay, let's complement what we got. Let's complement our iron condor with what we got here. And we're going to do that with this long call vertical spread. You can see how we ended up doing buying a 70, selling to 72.5. For those watching the Market Outlook live, I had to switch because the market was kind of moving. I had to switch the strikes to be able to get filled at where we wanted to get filled at. But you can see now it ends up being a pretty similar reward to risk ratio. Oops. Let's do this. There's the iron condor spread. You can see now my risk to the downside, because we have earnings coming out, my risk to the downside now is taken care of. I don't have very much risk to the downside. What I would make on the iron condor spread coming back would limit my downside on this long call vertical. If we do end up, remember this is 2 expiration cycles, right? We have here, let's do +2 expiration. We have both of these lines here. So if we do keep going up, I can limit my loss on the iron condor by just closing out the trade and letting this continue higher. So if you look at for example, my iron condor position, we're down about $100 bucks, $103. Maximum I can lose is 584. I would prefer to keep it to 416 or less. I'm at 100. If we keep going up, then I might be down a couple hundred. But the benefit to that is that now I have it offset by a potential reward of about $700 if we continue to move up. So, and again, limiting this risk by what I would make on the iron condor if we pull back to the downside. So I like the setup here. It limits my risk on any reversal, but it gives me the opportunity to take advantage with some gains that where I have very minimal risk. So it's not like, I mean, if you add those two together, I have about $1,000 on the condor, and I don't even know if I have $1,000 actually. If you look at my total risk on the condor, remember $1,000 is my normal risk for what we do in these in this account here. So I've got actually about less than $600 of risk there. If you added those two together, I'd have about a normal risk, but they're not additive because my risk is to the downside is very minimal. I mean, I have to really drop significantly. But again, I'd be closing out the condor if we drop significantly. Definitely be closing out this long call vertical. So I'd be limiting my risk over here. It's maximum about $1,100, but it'd be only about $600 plus whatever I lose on the vertical to my potential reward up here of about, here's the pink line up here, of about $1,100 up to the upside in this direction. So you see how this, how these two kind of complement each other and really kind of work out really nicely with a burgeoning bullish setup here on top of the potential with the earnings coming out that actually kind of helped me limit my risk in the iron condor setup that we originally had. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Subscribe to us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Monday evening, everybody, and we'll see you all next time.